Scott Middleton, the CEO and founder of Terem Capital, is on the pod from Sydney, Australia. Welcome, welcome, Scott. Good to see you.
Thanks for
Happy
having me,
spring. Happy
Devin.
spring.
I guess I
And
should say g'day because that's what
uh,
everyone's expecting.
oh yeah, that's you're supposed to say that's not a knife. This is a knife, right? That's what everybody here in the states knows. So we'll get into that later, but not to be American centric here. So Scott's in Sydney. Scott and I met on LinkedIn. So for all you LinkedIn haters out there, it works. So Scott was posting. We're posting or responding to like similar comments in somebody's feed, or I commented on your feed or something, and then we just kind of hit it off. And what I liked about you, one, is you're good on LinkedIn, so he's a good follow, Scott Middleton, on LinkedIn from Terem Capital. And then two, when we started talking in the DMs, I knew we'd hit it off. And you're working on something really interesting to a lot of people in the States, which is a software holdco, which for people who don't know, we're going to walk through all that. So kind of the fund versus fundless sponsor versus software holdco, and the value of that. So let's do this. How about you do a formal introduction of yourself, Scott? Because I'm sure you're just more than the CEO and founder of Terem Capital from Sydney. I'm sure you've got a much more interesting life story than just that. So how did you get here and what do you do?
Yeah, so my background. Hey everyone, my background is I built a mobile game when I was younger, about 14. I was a bit bored one summer and decided to build a game. This was before the app stores, and I built that, published it, and it was when you had to go around and find publishers to get things onto telcos for people to download it. It was kind of the time of snake. I did that and developed it, sold it, and it just developed a love of technology and the business of technology for me. I realized, hang on, you can sell software and people pay for it. I thought this was just having fun. And so kind of fast forward to today where I'm running a holding company that I'm the majority owner of. We own two current companies currently, and we've sold one a few years back, and we're looking to acquire our next two or three companies in the next year or so. That's the kind of fast forward. So I think it's kind of interesting to go back and say, how did I get here from writing a game to running a holding company?
And this was literally when you were like games, you had to basically get on with the telcos. Like you had to basically cut a deal with AT&T
Yeah,
or whoever, the Australian, was it Telestra or one of the big telcos there, to actually get on the deck, right? That's what they called it, like to be on the mobile
yeah.
deck
So
or something.
I fortunately was a bit too young to be able to pull off that kind of transaction, but I found a bunch of guys that were publishing games, and they loved the game so much they bought it off me, and then they went and published it in Asia, America, around the world, in Europe. Um, yeah, that was back in that time.
All right,
Um,
so that's at
and
14.
then
In your teens, you'd already sold the business.
yeah, and I bought a Nintendo, Xbox, and a boat. I think a small boat,
Amazing.
and then I didn't invest at all back into the business, and had a bunch of fun, which I think is probably correct as a kid of that age.
All right, so
Um,
then
so
you did you go to university, or are you like, I'm an entrepreneur, I got the bug, I'm just gonna do software development.
I definitely got the bug. I said I just want to be in business around technology. And from there, I ended up looking at what are the skills that I'm going to need to run software companies. So I went and worked as a software engineer for a bit, tried different ideas whilst doing this. And I worked as a, a SaaS sales rep before it was called SaaS. It was just called selling software licenses, selling to commercial real estate agents of all things. Um, and then realized like, no, I've just got to run a business for myself. And so I set up a product development services firm, helping startups at the time build their software for their software companies. And that was back in around 2010, 2011. From there, as we grew with the market, we now that business Terem now works with the kind of companies that Thoma Bravo and KKR will buy, and helps them as a genuine development partner to the CPO and CTO build the next version, the next iteration. So when those big PE firms or any PE firms are buying a company, they've usually got a plan, and they'll engage us to help them fast track that plan. Often because they can stop spending on us and show some good earnings in the back couple of years, but it all makes sense and it all adds up. So we love that kind of work because it's super driven, super disciplined, super focused. And then over time, through the success of that business, the development services business, I started looking at other things that we could do, and I came across an enterprise contact center software business that had been really a product that had been developed by one of the big insurers here, a $20 billion insurer called IAG, and we spun out that software company called Attune from IAG. I used the cash flow, the balance sheet of our business, led that M&A transaction, hadn't really done a big one like that before, and we sold that company 18 months later to a NASDAQ listed software company in the contact center space, and got like the kind of returns VCs would be aiming for out of it. And then had a bit of a moment where I thought, well, righto, we're good at this. We've learnt a lot working with these PE-backed companies, C-backed companies. How do we do more of this and apply a lot of the lessons we've learned? And really that came down to continuing to acquire companies, products, ventures. And so we doubled down, and a year ago, we bought a facilities management software business called FMI Works, and continuing to grow that business. And I guess that's how I came to the holdco model. I kind of came to it in a indirect way, more as a language and a model to explain what I was trying to do, which I hadn't been able to articulate for a lot of my life. And so that's how I came to the holdco model. And yeah.
Was that first acquisition spin out? Was the holdco in place at that point, and the holdco idea was, or was that an acquisition of Terem, the company, not the capital side?
Well, so in the very technical sense of the word, the holding company, the entity, we call it a PTY Ltd here, but it's a registered company. That's just what we call it in Australia. You could use an Inc. in the States, whatever structure you want to use in company form. It did the acquisition, it did the spin out, and so it did, but we didn't call it a holdco at the time. We were doing again, that's where I to it as a language and a community and a context to explain what we do and why it's interesting. It's maybe made it a little bit more appealing, whereas before people would be like, what, the overriding language and culture, I guess, in technology has always been this thing of, you got to be absolutely passionate about a problem. If you take kind of the VC style approach, I guess the VC kind of backed approach and culture, it's be absolutely focused on one problem. It should be what you live, eat, breathe, sleep, think about, dream about, and you've got to care about it. It's your life's work. It just never kind of gelled well with me. I'm too interested in the business of technology itself, and have quite a broad area of interest. I can get excited about solving almost any problem for anyone with technology, and then beyond the technology, how do you take it to market? How do you motivate a team to commercialize it? How do you motivate a team to scale it? All of that is fascinating. How do you invest well? All of that is fascinating to me, and that's my life's work. But I didn't have the language to articulate that, and this holdco, the popularity of the holdco concept, actually gave me a language and context. And in a way, people are now like, oh, it's an acceptable path for someone to take it wasn't so acceptable for a while. I even had a bit of an argument with a really well-known VC here who's quite critical of like, what are you doing? This is a waste of time. And I'm like, no, I think it's an acceptable path. It's yeah. There's no right or wrong, but it's just this is what works for me emotionally.
And we're in that first acquisition, were you looking for an acquisition, or did it fall in your lap and you're like, hey, we could do something with this. We've got the tools. We've got it. It was intellectually interesting, but also could be financially rewarding. And did you like go out and seek it, or did you stumble upon it and then kind of back solve for like, oh, we could buy this and fix it up and do that?
The answer's both.
Okay.
We were very much. I had very much formed the view that we were going to do M&A as a way of growing, and so we were we're building up the knowledge, capability, relationships to do it, all of that kind of thing. We're fleshing out what we wanted to look for, how it needed to be shaped. There's a few kind of false starts that we had, you could call it, around this space. We bought a company out of Estonia 5 years ago. It was less of a company and more of a product. This is back before SaaS acquisitions were a thing. Just figured it out, found a company in Estonia and bought it. Learned a whole bunch of lessons of that. I was actively looking for this kind of thing to do, and but this one kind of popped up, and I say that it was opportunistically popped up, but we were ready for it. Like we had the prepared mind, you might say, to be able to spot it, action it, everything like that. Whereas if I look at what we do today, we have a really disciplined approach and daily approach to sourcing, assessing, everything like that. Whereas that was more opportunistic at the time.
Great. Well, let's go into like what is a holdco, and what's your spin on it. And given that you've got Terem, the business, and then Terem Capital, kind of how did you go about deciding if what would be in Terem, the business, as M&A, and then what would be in Terem Capital as the holdco? So yeah, just walk us through the whole, like, what is a holdco, explain it, and your spin on it, and maybe if there's an Australian twist that may be different from the U.S. software holdcos. Let's cover that too.
Yeah. So what the holdco, just in really simple terms, is a concept of having a company that owns multiple companies. That's in its simplest form. That's how I think about it. And you can see from that simple definition, you can go in almost any direction you want. But what's emerged for me is there's a few models that have emerged as to how you might go about a holdco. We're kind of cool because it gives a bit of a framework. You can learn from others as to what they're doing. You can mix and match for what works for you and what you're looking for. But there's a couple of models. One is the roll up, which is your typical like PE play. Let's go and buy. I love the Twitter is always in anger over this one. There's a lot of good debate on Twitter around buying HVAC companies. Let's go buy some HVAC companies, stick them together. Whole bunch of plumbers in the Midwest, stick them together.
The HVAC roll-up meme game and Twitter is strong for sure.
Yeah, yeah, I love it. It's one of my favorite follows. So, yeah. That's your kind of PE-backed roll-up play. That is a holdco in its very real form. You've got one company, you buy a whole bunch, you can integrate them to different extents.
Yep.
Then you've got the transformer model. The transformer model is where you buy companies and you have a really set play around how you change them, and you're buying usually similar companies or companies that you can apply a similar transformation to. You're owning multiple of them, and your idea is you're getting a whole bunch of uplift on the value because of your ability to operate them well. I think one of the good examples of this is Bending Spoons is buying tired consumer software companies, essentially cutting them and completely like focusing in on the core of them, reducing the team size and putting the right team size in.
Famously just bought AOL.
I didn't know they bought AOL. I know they definitely bought I didn't. Yeah, I must have missed that one. I know they
Oh,
bought Evernote and a couple others. Yeah, yeah. I
yeah,
better
yeah.
catch up on my news.
I do think they're
Good
well.
one.
If they haven't bought it, they're circling it. But yeah, Bending Spoons, based in is it Italy? A European business, right?
Yeah, it's in Italy. Yeah,
Yeah,
yeah.
and yeah, buying up
And
old,
they
tired
shipped all the
businesses.
engineering. Yeah, that's a great model. I think there's like a bit of a VC play going on in this space of buying services companies, transforming them with AI. So that's your transformer model. We'll buy a whole bunch of services companies and use scale and AI to get lots of uplift. The Then you've got the accumulator model, which is where we fit, which is you buy, grow companies that have a similar business model, and you can cluster them around similar industries, similar customer problems, but you don't have to. So for us, it's buying SaaS companies, and we run them separately essentially. So Constellation is the most famous of this that a lot of people will probably have heard of. And then there's the diversified conglomerate, which is Berkshire Hathaway is famously number one at this. They buy businesses in any space, any industry, and they run separately. And they're quite diversified. Berkshire's in all manner of different things. But the interesting thing is with these models and with holdcos is they're not they've become popular recently, but they're not really a new. This isn't a new concept. If you go back, uh, the Dutch East India Company owned so many different types of operations throughout the world. There's the Japanese trading houses, there's Mitsubishi, there's the conglomerates out of South Korea. It's not a new model, and if you look back in almost any kind of rural town, you probably find there was someone that owned the local, the shop, the dairy, a few other things in town, the wheat. So I think it's not a new model, but it's gained in popularity as an alternative approach.
Well, the idea around software in this model was foreign to a lot of people. Obviously, with venture capital, they would never even consider the holdco model. To your, I guess I need to look up your argument with the Australian VC. That'll be good fun. But like that was is anathema to the venture model, which is like you build cool stuff from scratch, you move really fast and define or disrupt a market, right? Where like a GE, a Danaher, Berkshire Hathaway, Gulf and Western, these big conglomerates that had been like bundled and then unbundled, at some point. And then because software companies historically have been like, no, you either build one thing and dominate and disrupt or define, or you buy things and integrate them into the core, right? Your Salesforce.com, you buy Slack, you buy Yammer and these other things, and you integrate it into the core product rather than have separate entities, right? Kind of living next to each other, benefiting from each other, and having maybe some overhead on top on shared services. So, in your view of a holdco, um, are the businesses like the level of integration? Is there no integration? Some integration? Is that like how do you think about it as a holdco? Like you're just buying assets and keeping them completely separate. And in your version, and you can get as detailed as you want here, is like each of those companies have separate CEOs, separate full management teams. Like what happens above the companies you buy in terms of G&A or other things. Walk us through kind of structurally how you manage the holdco. Who does what?
Yeah, so the flavor you're pursuing definitely affects how you do this, and you want to think hard about it because it really affects what kind of acquisitions you're going to do, what kind of investment you're going to make in them, if any, how you're going to run them, what your goals are for running them, what kind of outcomes you're looking for. So it's again the good thing is there's some patterns forming for how to do this that you can lean on. But so when we get into how we thought of it, so we looked at it and it's interesting how you shape the criteria for what kind of businesses you want to buy. Then they end up shaping you want to run the holdco a bit. You look at where you want to go with them. So where we are is that the things we look for might be helpful because that actually informs how we've been running them. So we look for 1 to 10 million in revenue. Underneath that, we're really looking to drive profit on day one, but we say 1 to 10 million in revenue because we all know there's a lot of software companies that don't make profits today but could tomorrow. So we look
And
for
are
that.
you
We look for
sticklers
independent.
for ARR or subscription, or will you take a business that's not full subscription revenue? Like on the revenue side,
Yeah, so
how what will you touch?
we look at software and technology services, and we're very deliberate on that because we know how to run a good services business in technology, and we also know how to run a software company. But beyond the operational side, if you think about if you take facility and asset management, there are companies in that space that do really good services around implementation and understanding customers better. That if we own them as well as the software companies, we can have a really good understanding of what's happening in the market, a really close relationship with customers, and therefore better drive across the group value. So we're not sticklers for it doesn't have to be ARR. Um, we just want good technology driven businesses. So our second bit of criteria is it's got to be technology driven at its core. We don't mind if it's we don't even mind if it's project based, but those projects need to be centered on technology because we think it all comes together, and we've seen that ourselves play out repeatedly. So, and if you think about selling into a mid-market, large mid-market business, selling into a government agency, you can't just sell software to them. You need services to deliver the solution. So we often think like it's a technology solution in a lot of cases, not pure software, especially in the size companies that we're kind of talking about. But even the big Intel like Salesforce has a stack of professional services revenue in order to put their system in and make it work for their customers. So we're not sticklers for pure ARR at all. We actually we love a good reseller and implementer in the spaces we're interested in because we see it as a pathway to better IP, higher margin software as well. So yeah, number
Okay.
two is technology driven, and then the third one is we look for the team. There must be enough of a team in place or the ability to employ enough of a team for business to run independently. And then we look at B2B. We don't look at anything consumer. We only look at business to business. And that's partly driven by me because I'm a bit too rational and I only understand business problems. I struggle. I've realized I struggle with consumer products. So just yeah, B2B is a much simpler one for us. And almost the slower moving the better. And that'll and I just bring that up around the model because then it gives us we go into how to structure it with what we're looking for. It then makes you think about structure. So if it's a business of 1 to 10 million in revenue, there's a certain amount of support that it's probably going to need. If you've got a management team, so we can put a management team in place. They're running the business day to day, but probably they don't have an accounting and finance function of the level of discipline that we need as a holdco for ourselves and our shareholders. So we provide the accounting, provides probably we run the accounting and finance and provide that, and we provide a bit of HR as well, mainly because we want our people and talent. We view being able to provide an alternative place for talented people as a really important thing, but also from a compliance point of view, because we're of a certain size, there's a bunch of compliance that we have to meet, so it's just a necessary part of doing business as well.
So with
So
your
that hopefully gives a bit of an idea of the structure.
yeah, no, helpful. And so the sellers, if the main owner of the business is stepping away, would you do that, or do you want the management? Do you want the owner to stay in place? Kind of owner versus management team staying in place. Walk me through kind of your
So
decision
we're
criteria
indifferent,
there.
which also yeah. So we're indifferent, but we need to be able to. We've looked at businesses, for example, where you can tell if they go, we're going to have to hire 5 people, and the P&L just doesn't support that. So that's not going to work for us. But if they've structured the business well, and we can replace them with a general manager or a CEO, then we're very happy to do that. And we actually have found that there's a lot of people who are a bit ex big consulting firms, ex PE, ex VC funded tech businesses, really good, talented people that want to come and work in a holding company because they like the philosophy and the different approach that it brings. It's the discipline without and the professionalism, I guess, without as much of the that push for growth that you can get in a well-run VC-backed business.
Yeah. Or like the go big or go home, right? It could, like, you could place all these bets,
Yeah.
they not work out, and then it's like, hey, we're moving on to the next one rather than we're going to cut back and grind here. They're actually just going to move. I mean, in the worst VC outcomes is they tell management, go for it. Something cracks through no fault of their own, right? Global financial crisis, this or that. They've overspent. VCs don't have any more money or don't want to put money into a business that's not growing as fast anymore. They move on to the other 29 companies in the portfolio, and you're kind of left behind, even though you did what you said you were trying to do. So yeah, we get that. So there's a new manager, general manager, CEO in each of the businesses. They each have their own leader, own management team. So you're not stepping in for your team isn't coming in for permanent interim roles.
No. I learned a long time ago that if you don't have someone waking up in the morning and the first thing they think about in the shower needs to be what you need is someone who wakes up in the morning. First thing they think about in the shower is how am I going to make this business succeed? If you don't have that, you've got in my view, you've got a problem. If they're too split focus or anything, and so interim. So one of the things that really, for me, meant this was almost a no-brainer model to pursue is that you mentioned the interim thing. I've done every role in a software company, and so if I do need to step in, I can. And so where others see operational risk, I see just this is this is just life. Someone's not shown up. You got to step in and show up at the conference and pretend you know what you're talking about. I've given a talk on enterprise contact center management. I've never managed an enterprise contact center somewhere, but someone was sick and we needed someone to fill in it, so I showed up and gave a talk. It's one of the most bizarre experiences of my life, getting congratulated by the audience for all my knowledge on contact centers, and I'm like, I just regurgitated what someone else told me, and kept a straight face. So, but I guess what it is, that's all. I actually love, I love that stuff, and I wake up excited about it when I get to do it from time to time, because it can be a bit more interesting than thinking about capital tables and financial models, to be honest. So. That's one of the things that drew me to the holding company model. Like what I like about this model, I guess, and what gives us actually, because we've got similar people around the group, it gives us a bit of an edge, if you will, over a pure financial team approaching this.
So you said you guys handle finance at the Holdco for the companies. Is there anything else you handle? Like, how is the Holdco staffed? Like, what's your team at
level? Yeah, at Holdco level, myself, I've got a bit of part-time allocation from our private equity firm shareholders from the investment associate. We've got our internal accountant, as well as our external, just to really get the discipline in there. But that's it at the Holdco company. Holdco level in the Holdco company at the moment, and actually I'm inclined to keep it as lean as possible, because AI is affecting us. AI is so interesting in this space, like the way we're formulaic in how we assess a business, and so there's a lot we can do to really automate a lot of our process, but the other functions. So I really take on M&A myself at the moment. And I really don't see us growing the team out at that level. Following in the style of Berkshire, trying to keep it as lean as possible at the top will be something we do indefinitely, I think. Yeah, if that helps you understand the holding company level.
Yep. And how much do you think your time, like, how do you balance time between finding the next acquisition for the Holdco versus oversight of the current companies in the Holdco versus M&A for the companies in the Holdco, if they're pursuing M&A? Like, how do you think about where your time gets divided and energy?
Yeah, so about 60% of my time, so 3 days a week, is on M&A, looking at opportunities, sourcing opportunities. I've realized there's something a bit magic about, you know, founder reaching out to other founders to talk about selling their company. It's a bit of a superpower.
Totally
So
agree.
I've got to use that unfair advantage that I've got in as many ways as I can. So that's also, it's where value is mainly created in the holding company model. Yes, you're going to get some value out of your company's growing profits, but M&A is really where a lot of the value is going to be created in the long run. And so then I spend 2 days a week on the companies themselves, working with the team. But it's not, I don't work in the businesses, it's often working with I should say it's a day a week on the companies themselves, and then another day, so we've got a 5-day week, and then another day is more on holding company stuff. So that day a week with the companies, like later today, I've just got a day of the monthly, it was the end of September. We've had a few days to get our reports together. I go and sit with each of the management teams for 2 hours, and we talk about everything going on in the business. And that's my day a week for the working with the businesses to grow profits. Because in the holding company model, growing for us anyway, in our model, being able to grow our profits every year is a big driver of success. But we don't have to grow them significantly. If we can just get 10 to 15% growth every year averaged out, that's great. It's never a straight line, but if we can get that, that's fantastic. It's just reminded me of talking about the model and what's important. That amount of growth is all we need, which is quite interesting when you compare it to PE and VC, and the level of growth, especially in VC, that you need in order to drive returns. And so when we look at that amount of growth, that's kind of our baseline that we're looking to get out of a business that we want to be able to drive. And then above and beyond that, we know in software companies that, and you would have seen this as well, I'm sure, sometimes you're just in the right place, right market, right time. And because it's such a high margin business, and if you're in the right trend, you can really see significant growth that you've applied all the same practices, playbooks, frameworks, everything, right place, right time, you can get much more growth. So like that we're expecting, like we had a great outcome with the sales business that we expect we'll see more of that on the growth front as well, and businesses that we buy, just by the nature of what we're in. But I think it's one of, like, we'll do all the right things to be in the right place, play the game properly to the best of our ability, but I think the market will pick some up.
Great. All right, so
yeah,
we've zoomed. We've zoomed.
Yeah.
Yeah, we've zoomed in on your business and how you do it. Let's spend some time now zooming out for people listening who maybe aren't as familiar with the Australian software market. I'd say anecdotally, I've seen a lot of U.S. Private equity hunting around in Australia for add-ons as well as platforms. Even small cap public Australian companies being targets for U.S. private equity funds. So you're on the ground. You've been in the space for a long time. You're actively, sourcing deals. In kind of holdco private equity guys speak, like, break down the Australian software market opportunity for us, and then zoom out, and then kind of maybe zoom into sourcing and how sourcing works in the market.
Yeah, yeah, can do. So the Australian software market, there's about 2,000 software companies in the range that we look at, which is that
1 to 10
million.
Great.
And that's using kind of Crunchbase data that we verified a bit. outside of that, there's a small number that are of kind of like, more the PE scale. And you mentioned, Thoma Bravo has bought recently in the market. KKR's bought. It's not just the US firms, the Europeans are here as well. EQT is here and has bought software companies. Um, the the what's going on within the market in a bit more detail is you've got these. We had a big kind of boom in venture capital in 2020, 2021. I don't think Australia is unique in this, but I'll just give the Australian flavour of it. So what that led to was record number of VC funds being raised, record number of VC funds being deployed in software companies backed, and what we have now is about 800, somewhere between, 500 and 900 software companies that have had some level of funding below about $10 million that need an exit for their investors in the next 2 to 5 years. And so we see this as a really good opportunity because we don't.
Is that on top of the? Is that on top of the 2,000, or is that?
That's within the 2,000.
That's within the 2,000. Okay.
Yeah.
So there's
within the 2,000.
Yeah. So there's some that are owned by owner operators who may have no interest in selling or aren't ready to, but there's this sizable group in there that's institutionally backed that there needs to be some liquidity at some point. So we would, U.S. we'd call those like there's an order of magnitude greater in the U.S. of that number of companies, and we can go sort them by how much have they raised, which is like if they raised 100 million, well, that would be tough for us at our size to go buy them even at, a loss potentially. When was the last time they raised? And if you see like, oh, they've raised 10 to 30 million and they haven't raised in 3 or 4 years, like that should tell you something, that maybe they're a target for this venture orphan category, right? They're not the loser. They're not the zero in the fund. They're certainly not the breakout return the fund deal. There's going to something's going to have to happen at some point. And if you can get the investors to capitulate, if you can get you can get a message into maybe the founder, maybe the non-founder CEO about, hey, there's a better path here. It may not be perfect for your venture guys, and it wasn't what you drew up, but I've got a solution for you if you want to talk.
Yeah, it's exactly the same. Just the scales are different. You almost got to think of it as like one of the states, as in one of the individual states in the US is kind of the market size. So there's a small number of PE firms that are software specialists. So there's something like by our count like 20 firms, the Australian firms that will make investments into software or technology companies, but they're a bit more generalist. You also see that they're bought into a logistics business or something. And there's really only one specialist software investor, and they don't really go below 10 million in revenue. So there's just this gap there because the Thoma Bravos and yes EQT and Thoma Bravo and KKR are in the market, but they're buying our listed businesses that have got a 500 million plus valuation in a lot of cases. So it creates this gap in the market where there's just not a focus, and it's why I did toy with it one time, like, oh, we could go and buy a lawn care business. Isn't it cool what all these people in the States are doing, rolling up lawn care businesses? And I thought, no, like, we know software well, and having the specialization, I'm sure you've got some strong views on this, Devin, like having the specialization in software serves us really well, and just focusing purely on that, because I also think even though the way I describe the market, there's still a fair bit of competition for opportunities from trade buyers, from PE funds that have invested already and are trying to roll in other businesses. And so we've got to be pretty sharp in our ability to respond quickly, ability to respond well, and ability to take on operational problems. Honestly, in a 1 to 10 million business, you're buying those opportunity issues that if you do it well, you've unlocked value, and if not, so I think we've just decided to absolutely focus in on this so we can win in this space. Things are priced a little bit sharper than other areas.
So let's talk about sourcing a little bit. So, I mean, a junior sourcer at a U.S. private equity fund could call 2,000 companies, every month, or at least carpet bomb them with AI generated emails about like, hey, I've got $10 billion. Please talk to me. I agree with your comment that the founder calling the founder is a very different conversation and a much higher hit rate. So 2,000 companies, you could get to them every year. One, two. So that's one is like, how do you, with 2,000 targets, I know you need one or two a year to keep pace and to feel good, maybe, right? So you don't need 2,000. But one, not hard to get to those 2,000 through email or outreach or whatever. Two, how much of that world, 1 to 10 world, is banked versus unbanked? And kind of what's that dynamic in Australia?
What do you mean by banked versus
Oh,
unbanked?
they hired an investment banker to transact.
Ah, yep, yep. So yeah, we getting around is part of it in all the different ways you can direct, like events, everything like that. Fortunately, we've been in the market a while, so we know a lot of the people in the market, from the VC firms to the PE firms. Um, that's part of it. They're a decent source of like possible opportunities as well. And so there's, and then on the advisor front, there's a small number of advisors who are good with software, and it's also just a case of in front of them. We're more advisors than bankers is what we see
Yep.
at our end of the market. So getting around, getting in front of them, being known by them as to what we're looking for, and so yeah, it's just that's the sourcing front. If does that capture what you were?
Yeah, yeah. Just like, are
What
you
you?
is if a advisor, we would call maybe a broker, an advisor versus a bank, calls.
Yeah,
A lot of our deals in the U.S. are just unbanked because they're not sexy enough to be, taken to market to 100 potential buyers. Right? There's kind of pretty nichey. The founder stepping away. Maybe the growth isn't that good, or the profitability isn't great. So there's something operationally that needs to be adjusted. So those don't suit well for a broad process, and they're hard. So if a broker or advisor were to call you, is that a positive sign? Like, oh, there's intent to sell, and there's going to be a beginning, a middle, and an end in a process. Versus, I'm just talking to a founder, and he may change his mind 9 months into this after I thought we were having a good conversation. Like, how do you think about that? Is that a positive sign for you, or would you rather just deal directly with the founder and kind of take the risk that they may change their mind, or it may be a long
yeah.
sales cycle?
I mean, we're indifferent, and I think because of the size of the market, there's a little bit more around um, reputation and relationship, just the nature of it. A lot of people know each other, or by 1 or 2 degrees of separation, they can quickly do a bit of back channel on you. And so I think the the approach we've taken is one of really more the long term, and because we're in it for the long term, so this works. But we're very patient, so we'd rather be more educational with people around. For a lot of the founders that we talk to, and the VCs, frankly, it's not a model that they're super familiar with as an exit pathway, and they're not super familiar with these things what these businesses are valued at, even the advisors to some extent. And so we've learned to actually take less of a transactional approach. Like, hey, we've analyzed your business, the spreadsheet says this, and we actually spend a lot more time on the educational front of not even trying to convince them of what the value is, but just, hey, these are the things in your business that are driving the multiple that we'll be able to pay, and here's comparable transactions. Um, Here's what things are trading for in this space. Because I just think in Australia, at least, the narrative. I don't think Australia's alone. I spent a bit of time in the States, and I think the similar one here. If you're in technology, a lot of your dominant source of information on company valuations is the headlines of, so and so software company was valued at whatever times revenue. And so a lot of our work is actually the educational side of, hey, this is what, yes, that company got bought by Google for 40 times forward revenue, but the reality is you don't have that secret that they have. Um, we've got to say this nicely and diplomatically. The reality is you're running a business that's earnings based, and I think that goes to it's the two-speed thing. There's software companies that are actually better in the holding company world than in the VC world.
Yep. And as you think about holding versus monetizing, so the first acquisition, that Carver, you transformed and sold. So good on you for that. As you think of, the good news about the Holdco is, hey guys, you don't need to, go big or go home. We can compound this over a long period of time. You can have stability, resources, which is, I imagine, highly appealing to people who have bought lottery tickets at venture companies that never hit, and feel like they got paid less than they should have for an equity payoff that never came. But also in a traditional private equity or venture deal, for certain types of managers and type A executives, they like that there's going to be a payday at the end and that they're driving this towards an outcome. So how do you deal with that with as much as you'd like to talk about it? Like, one, the management team can get the best of both worlds, right? Run a private company that has private equity venture discipline, venture excitement. We're going to be modern. We're going to be innovative. Private equity discipline. We're going to run this thing profitably and have standards. But also like the equity side, like, hey, I wouldn't mind getting a payday here for the effort. How do you thread that needle in a holdco?
Yeah, really, really happy to share it. So we think about it as there's if you're one of those key people, you've got your base salary, which is kind of your market salary for the role that you're doing in the size company that you're doing, and there's plenty of benchmarks you can use to get that. Then we share in profits. So we set a budget. If you hit budget, cool, we kind of earn your base. If you beat budget, we'll share in beating budget with you in a cash sense. So you're incentivized to grow EBIT, and that's the second part. So 100% alignment on why we own the businesses generate EBITDA, and we own them to grow 10-12% every year or thereabouts. And so if you're hitting that and beating it, we want to share in that with you, and we share pretty generously in that with them. And then beyond that, for managers that have been with us for over a year and have proven themselves, we allow them to buy in to the holding company, and it's a buy-in. It's not a stock grant, because I don't think people value stock grants in the same way they value putting money on the line. And we want people that can be around and have a little bit of hurt money in the game. And so we do give a kicker on top of that, though, for management. So we've got whatever they put in, there's a kicker. So if we hit certain return, so multiples on invested capital return hurdles, then their options are able to be, their options become vested. They can stop them, so their kicker becomes real, and it's favorable to them. So that's how we think about the long run incentive of people being involved. And we also, similarly with founders, we if they stick with us and they're fit with the model, we invite them to roll some of their earnout into equity.
Great. So as we wrap this up here, I've already gone for almost an hour, which is always surprising, how you can nerd out on these things and lose track of time. Anything you want to cover about kind of Australia versus US? Anything kind of like, Holdco versus private equity fund versus fundless sponsor, or anything else you want to cover in the last few minutes here?
Yeah, the one thing that we haven't touched on that's become more and more apparent to me with the holding company model, which is we can talk about all the technical stuff. We can talk about like the different models you can use, and we can build spreadsheets and PowerPoints until the cows come home, so to speak. But the thing that I've come to realize is the most important with the holding company model is patience, which is actually really, really hard. it's very easy to there's plenty of opportunities to go like, oh, if we just do this and put this amount of money in, we can probably get this opportunity, and if it works, we'll walk away like heroes. But a lot of the holding company model is waiting for compounding to happen, waiting for results in a business to happen, waiting for your bank balance to improve where you can do that next acquisition with a little less dilution, waiting until the right opportunity that really fits your model comes about. It's different. There's no, if you think about the fund world, which we toyed around with, it's got pressure to deploy, and you need to, and there's a bit of a justification, get out and deploy, whereas the holding company model is patience, and it's hard patience, and there's no headlines, and there's no good news if you need to. There's no big news if you're just patiently waiting for the right opportunity at the right price. But that's where the value is really created.
Yeah, to use a U.S. sports analogy, like it's like playing baseball but you can't strike out looking. You could look at every single pitch and never swing at one, which is great. Eventually, your investors or your team will get itchy, and you're like, we got to swing at one of these pitches. But you can wait for your fat pitch. And the way Warren Buffett used to explain it would say, hey, you have an investor, professional investor, private equity. Maybe you lead 12 deals in your entire career, right? One every other year for 25 years, so you've got 12 punches on a punch card. Like, do you want to use one of those 12 on this deal, right? You're going to use up one of those because there might be another one. So balancing that, like, hey, I want to move and generate value, and the faster I move, the faster it compounds if we're successful, versus we made a bad decision and it's like taking up a ton of time, it's decreasing value, it's reducing our cash flow overall across the holdco, that we now can't make that next investment because we've got to clean this up first. So I imagine it's a constant push and pull for you to do it. And so if we talk a year from now, talking about patience, if we're talking a year or 18 months from now, how many more assets have you bought? What's your sense of what does Terem Capital look like in the next 12 to 24 months?
Yeah, for us, it's doing 2 more acquisitions in the next 12 months. That lets us balance. That's the patience thing. I'd love to do more. We've looked at plans of like, do we just raise a lot more capital and deploy it? But then there's a whole bunch of other consequences that come with that. And so ours is get 2 done. And actually, if you can, my view is very much like any business we buy. If it was the last business that we bought, to the whole pun analogy, would we want to be in it? And if we can answer that, then we actually can't fail, which is the really exciting thing about it. Like, if we just keep going into businesses they might be the last one you buy, then happy days. And probably the opposite will happen. It'll be the last one because you'll have bought well.
Well, private equity and the holdco models are great for people whose hobbies are private equity and buying software, fixing software companies. So it looks like you found your passion, which is good. All right. So if a founder, you only buy companies in Australia, or would you go further afield? You bought that one in Estonia, but for your holdco, how far will you go to find one?
Oh, look, 80% of our attention goes to Australian companies, but we're looking at 2 companies in the States at the moment, and 2 companies in Europe. So we're definitely open. Look, a lot of good software companies, in my view, should and do have customers globally. So it's a really interesting. More what we think about is like applications and running remotely, but most of the companies we look at have international customers anyway. So it's not. Yeah, we'll look in the States and Europe as well.
Great. And if a founder hears this and wants to reach out to you, how do they find you, Scott?
Yeah, just jump on terem.capital and you'll find a little form you can put your name in, put your email in and say hello, or you can look me up on LinkedIn, Scott Middleton on LinkedIn, you'll find me.
And I'll say he's a good follow. That's how we met. And he's not scared to let it rip. In true Australian fashion, he gives zero Fs and says what he thinks in a respectful way. I think you used the platform in the way it was intended. So thanks for that. Scott, this was fun. I've never been to Australia, but I want to go. So now I know I've got somebody to take me out for a pint in Sydney when I'm then. And the same goes for you in Chicago. Please, when you're in the States, if you're looking at a company, have an excuse to come through Chicago, and we'll take care of you.
We'll do. No, and we'll go sailing. We can have a pint on the harbour.
That sounds amazing. And I'll find somebody with a boat here, and we'll take you on Lake Michigan, which, if you squint, looks like the ocean.
No worries.
Thanks so much, Scott.
Thanks for having me.
For sure.
From the heart of Chicago to all over the globe, a couple private equity geniuses, they share what they know. They love to mess with technology where the future is sink or swim. It's the Private Equity Funcast with Devin and Jim. Technology issues and middle market PE-backed companies, they bicker with each other and they don't take themselves too seriously. It's not venture capital, it's private equity. It's the Private Equity Funcast. Pour yourself a drink and have a seat. It's the Private Equity Funcast. That equity is private. If PE excites you, let it show and do not hide it. Devin and Jim.